I need to tell you something, and I need you to actually hear it. The more you trade, the poorer you get. Not sometimes. Not in bad markets, always. On average. Across every study ever done on this. This isn't a theory. This is what the data says. Consistently. Across decades. And the worst part? The people losing the most money think they're the best at it. In 2000, professors Brad Barber and Terence Odian published a landmark study. They looked at 66,465 households and their trading accounts over 6 years. The average active trader underperformed the market by 3.7% per year. The households that traded the most underperformed by 10.3% per year, every single year. Over 10 years, that gap is the difference between retiring comfortably and working 5 extra years. That's not an opinion. That's math. Right now, some of you are thinking, but I'm not like those people. I do my research. I watch the charts. I have a system. I know. They all said that. Every single one of them. This is called overconfidence bias, and it's not a character flaw. It's a feature of the human brain. In study after study, 74% of fund managers believe they are above average investors. Mathematically, only 50% can be right. The more someone trades, the more confident they become, regardless of their actual results. Activity feels like progress. Checking the app feels like work. Buying and selling feels like doing something smart. But the market doesn't reward activity. It rewards patience. And patience is the one thing overconfidence destroys. There's another reason frequent trading destroys wealth. Every trade has a cost. Commissions, bid-ask spreads, taxes. A single trade might cost you 0.1%. Sounds small, but 200 trades a year at 0.1% each, that's 20% of your portfolio gone before your picks even matter. And short-term gains are taxed at double the rate of long-term gains. Every time you sell within a year, you hand the government a bigger slice. The buy and hold investor pays taxes once, maybe twice in a lifetime. The active trader pays them every year, sometimes every month. The government loves active traders. Now here's the story that ends every argument about active trading. Fidelity Investments analyzed which of their accounts performed best over many years. The answer was not their most experienced traders, not the ones with the most sophisticated strategies. The best performing accounts belonged to people who had forgotten they had an account. The investors who did nothing, literally nothing, beat everyone else. No panic selling, no overconfident buying, no trading costs, no emotional decisions. The best financial strategy in history is also the most boring one. Buy, hold, wait, repeat. A portfolio left alone for 10 years will almost always beat a portfolio actively managed for 10 years. This is not motivational. This is empirical. The math doesn't care about your strategy. It cares about your costs, your taxes, and your patience. Reduce the first two, maximize the third. Every news headline is designed to make you act. Acting is almost always the wrong move. Fear pulls you out at the bottom, greed pulls you back in at the top. Both cost you everything. Discipline is not a personality trait. It's a decision you make every single day. The forgotten accounts at Fidelity didn't have a strategy, they had something better. They had time, and they got out of their own way. Trading feels like control, but the market doesn't care how hard you work. It doesn't reward effort, it rewards discipline. I'm the honest dollar. I've been traded, flipped, lost, and forgotten. And the accounts that forgot me, they turned out just fine. Next week, why losing $100 hurts twice as much as winning $100. And how that asymmetry is quietly destroying your portfolio. Subscribe. Your future self will thank you.